All right. Good morning. It is 10 o'clock. We're going to go ahead and get started right on time. My name is Arwen, and I'm very excited to welcome you to today's employee webinar, Understanding Your Health Plan Options, specifically highlighting the difference between traditional and high deductible health plans. So, a little bit about me. Again, my name is Arwen. I am the marketing specialist here with Alliant, and one thing that I love to do is I love to share information about insurance in a way that is more simple and easy to understand. And so I do a lot of the benefit meetings and education to make sure that really my favorite thing is when people have those light bulb moments where they finally realize like, oh, I get it now. You know, it's stuck in the old brain now. So I'm really excited to take the time today to go over this with you. And my goal and my hope for today is that this is the presentation that will really hit home on the key differences between these two plan types. Now, in today's presentation, we're going to talk about what actually makes a qualified high deductible health plan. And then we're also going to talk about first dollar benefits, cost versus risk analysis. We're also going to talk about how to better understand your medical forecast as well as HSA bank accounts. So let's go ahead and dive right in. Now, for one thing that I think is really important is in order for us to really understand today's content and what it is that we're going to talk about, we need to make sure that we are refreshed on these key terms. So that way, as we go through the rest of today's discussion, we're aware and following and tracking on, what it is that we're talking about. So first things first, what is a deductible? A deductible is how much money needs to come out of my wallet, my bank account, before the insurance company starts to help me out. If I'm meeting my deductible, my wallet is wide open, money flies out of my wallet, and I'm responsible for 100% of my in-network covered services. Once I meet my deductible, then I'm in co-insurance. And when you think of the word co-insurance, think of the word co-pilot. I'm co-piloting the bill with the insurance company where they're responsible for a percentage and then I'm responsible for a small percent. And I do that until I hit my out-of-pocket maximum. My out-of-pocket maximum is when my wallet closes for the year, goes back in my pocket, and then the insurance company pays for 100% of my in-network covered services. So as we go through this process of deductible, co-insurance, out-of-pocket maximum, we go through this process where I'm responsible for all of my bills, some of my bills, and then none of my bills. And then a copay, that's that flat dollar amount that we pay to access services. Things like seeing a doctor or filling a prescription, those things that maybe we're a little bit more common or more comfortable with the concept of. So now that we have this base understanding, let's go ahead and jump into really, kind of the nitty-gritty of what makes something considered a high deductible health plan. Now, for those of you that had insurance pre-Affordable Care Act or the ACA, you'll remember a time when deductibles were 100, 250, 500, $1,000. And so when you compare those old plans, you think to yourself, man, everything seems like a high deductible now. But the IRS actually truly does have some definitions of what makes a qualified high deductible health plan. And a qualified high deductible health plan essentially means, can this health plan be paired with a health savings account? So, first things first, the IRS does require a minimum deductible. The deductible can only be so low before it is not considered a qualified high deductible health plan. And that number changes from one year to the next as the IRS makes adjustments. So you can see here for, individual and family, we can see that it was one amount for 2025 and it's projected to be, upticked slightly for 2026. The other piece is that in order for it to be a qualified high deductible health plan, there is a maximum out-of-pocket limit of how high that out-of-pocket can be. And we can see here for 2025 and 2026, those figures. So that is the most that an out-of-pocket can be. And which is actually lower than what the legal limit is. I think the legal limit these days is either $91 or $9,300. Another key element of in order for a plan to be considered a qualified high deductible health plan is that it has no first dollar benefit. And we'll get into in just a minute, what does it mean to have a first dollar benefit? And then, of course, all of these things together means that it is a qualified high deductible health plan. Qualified meaning that it is compatible with an HSA bank account. So we'll get calls from time to time when they say, Arwen, I do have a high deductible. My deductible is $3,000, and so why can't I contribute to an HSA bank account? And the reason is because maybe this plan doesn't meet all of these requirements. It has to have that minimum deductible, has to have that maximum, and cannot have first dollar benefits. If any one of those three things is out of alignment, then it is not considered a qualified high deductible health plan. So a first dollar benefit, essentially it means that I am receiving essentially a benefit from the insurance company right away without having to meet my full deductible first. And so strictly, we're talking copays. If a plan has a copay before you meet your deductible, then that is what's considered a first dollar benefit, and it does not qualify as a high deductible health plan. So a first dollar benefit is considered like an upfront benefit, something like copays for primary care, urgent care specialist, emergency room services. There's also some plan designs. They're less common than they used to be, but we'll see them from time to time where you get some lab work benefit. Oh, like the first $400 in lab work is covered, and then after that, it's subject to the deductible and the coinsurance. Now, it's important to note that preventive services not considered an upfront benefit. Preventive services are covered at 100% right out of the gate, regardless of if you've met your deductible already or not. And that is because the Affordable Care Act classified preventive services in their own category. So that way they are protected. And if you're on a high deductible health plan, you can get those preventive services right away. All right, let's talk about cost versus risk. And so essentially, when we talk about insurance, that is really what it's just coming down to, is what am I willing to spend to minimize my potential risk? And so essentially, buying insurance is is purchasing the right to transfer risk to the insurance company. So when we consider things like premium or, claims, think we're going to start talking about that in a cost versus risk perspective. And so we see that some people, say, you know what, I would rather spend more money out of my paycheck to have less risk, right? I would rather it cost me more so that I can have less risk for potentially later. So a traditional plan typically is more expensive out of your paycheck to sign up for it, but it typically also can have lower deductibles or a lower out-of-pocket maximum. And the traditional plans also have a first dollar benefit. So that's usually going to be your copays for your doctor's appointments or for your generic or brand name medications. Inversely, the high deductible health plans typically are less expensive to sign up for. They're typically less out of your paycheck per paycheck to have those plans, but they have higher deductibles and can have higher out-of-pocket maximums, and they don't have that first dollar benefit. And so that's again, when we're talking about cost versus risk, let's break that down. So cost is spending money that you to have something. When you think about any kind of insurance, health insurance, car insurance, homeowners insurance, you pay a premium to have that policy. It costs you money. If your household expenses were a business, that would be considered an expense, right? It's money that you are spending no matter what happens, regardless of if a claim happens or not. You spend that money to have that insurance. Risk, on the other hand, is money that you could potentially spend if something were to occur. Like if you were to end up in a car accident and go to the hospital, then those hospital bills, it's a risk that you could incur those hospital bills. In the same way that if you were to get in a car accident, the risk is that you would have to pay your car insurance deductible to get your vehicle repaired, or even if it's totaled. Or if you are like me and you have water damage in your house, then you can expect to pay for your deductible for your major home repair, or in my instance, getting all of your hardwood floors replaced, because that happened. So, now that we're talking about this kind of cost versus risk perspective, we're going to use some very, very rudimentary examples. What I have here is these buckets. I tried to find something that didn't look like a trash can because that's not what we're trying to suggest. So, but buckets is where we're at. So if we're looking at a bucket from a sideways perspective, then this is what I want you to start thinking as we're going to start looking at in these terms. So when I'm talking about a traditional plan, PPO plan with copays, it might cost me more every year to have that plan, but I have less risk because I'm purchasing a plan that has a lower deductible. Whereas when I have a high deductible health plan, maybe it doesn't cost me as much, but I'm assuming more risk, right? Now, let's talk about your medical forecast. This is a really key piece in understanding your tolerance for risk. So, when we talk about forecasts, the number one thing we should look at first, usually prescriptions. So, ask yourself first, when you are making this assessment, when you're taking prescriptions, do you have prescriptions that you need to fill regularly? And how much do those prescription cost? So, for example, I'm on a high deductible health plan, and it works really well for me because I take two medications. One is preventive, so I don't pay anything for that medication. You can see here in this examples, right? There's a $0 medication that is covered as preventive. Or I might take a really inexpensive medication. The example here is escitalopram, which can be between $5 and $15 to fill, right? Very, very inexpensive medication. Or am I managing a chronic illness or a condition? Maybe I'm a type 1 diabetic and I'm buying the Dexcom pumps and the glucometers and the insulin. Or maybe I'm on Humira or an injection and it's very, very expensive. These are the kind of things that you need to consider because it's going to play a factor in what plan is best for you. I think a lot of times people sign up for insurance and then try to mold their healthcare needs around their insurance when your healthcare needs should dictate which insurance plan you are signing up for and molding your insurance around your needs. Another key element when you're considering your medical forecast is going to be your surgical needs. Do you expect to have any major services or procedures that you need done? Examples might be that I need to have a hip replacement or a cataract removal or a knee replacement. Maybe I'm going to have a baby, for example. So, it really comes down to what is the likelihood of you needing to have a surgery? Because again, surgeries are very expensive. Most people end up meeting their out-of-pocket maximum when they have a surgery. Maybe not if they have it at an outpatient surgery center, but they're certainly going to meet their deductible, is what we usually see. So these are the kind of questions that you should also be asking yourself when it comes to assessing your risk. And then again, I mentioned those chronic conditions, right? Again, if you're a type 1 diabetic or if you're managing some sort of chronic condition, like rheumatoid arthritis, for example, maybe it requires you to have regular visits with a specialist to manage your condition or have treatment, or maybe you need to have more imaging services done to determine the status. A lot of people need like an MRI or an EKG every year to determine how their chronic condition is being managed. And so this is another key element of, okay, how do I expect to use my insurance? What sort of risk am I looking at when it comes to, what my potential claims could be? And then look at your historical data. You can also estimate your forecast by looking back at historically, how have I used my insurance? So one example here is I have screenshots of, and this is actually my explanation of benefits from 2022 and 2023. And when you look at your EOBs, or explanation of benefits, you're going to see generally somewhere on there a thermometer that fills up over time, that shows you how much you've had applied towards your deductible, towards your out-of-pocket maximum. Now, I'm enrolled with my spouse, so I am subject to a family deductible. So you can see here in 2023, I only had, between my husband and I, we had less than $600 in medical bills. And in the prior year, 2022, we had less than $1,000 in medical bills. And so looking at your historical data can sometimes help you dictate, okay, on average, this is about what I need my insurance for, especially if this is what you consider to be typical years. Okay, so now that we've considered that, let's talk about some different examples. So for me, again, in 2022, less than $600, 2023, or vice versa, less than 900. So for me, I would have been better off on this high deductible health plan for two reasons. Year one, I had less than $600 in medical bills, and so it would not have behooved me to sign up for a more expensive plan to have a lower deductible because I didn't even hit $1,000 in medical bills anyways. And then the next year, again, I had less than $1,000 in medical bills. So I would have spent out of my paycheck, cost is gone. That's money out the door, can't get it back. So I would have spent more money to have a lower deductible that I never was going to hit in the first place. I would much rather, and it worked out much better for me, to be signed up on this high deductible health plan because it costs less out of my paycheck, less money went out the door, and this $2,000 deductible didn't really matter to me because I wasn't going to hit the $1,000 deductible anyway. So based off of my utilization, it made more financial sense for me to keep my per paycheck cost as low as possible, considering that I didn't even hit what the traditional deductible would have been. Now, let's pair this with a health savings account, bank account. And so, when it really comes down to, okay, how do these plans work really well together? That's when the HSA bank account really comes into play to be most effective. So, an HSA bank account is a very special type of bank account that you can use to pay for potential medical, dental, and vision expenses. So, it's a very special bank account. I think of it as my medical nest egg. So, no matter what my condition, or not my condition, no matter what my financial circumstances have been throughout the years, I have always been very careful to put some sort of money into my HSA bank account. And that comes out of my paycheck. And so, depending on my situation, sometimes it's $25 a paycheck, $50 a paycheck, $75 a paycheck. And right now, I'm at $100 a paycheck that I have coming out of my paycheck going into my HSA bank account. And the reason for that is that I want to save money for those potential expenses. And because it's sitting in a bank account, it's a savings account. It rolls over every single year. There is no use it or lose it. And so that way I can build up this nest egg so that if something does happen, then I'm not putting money on or putting medical bills on a credit card or tapping into my like checking account, that sort of thing. Now, because the IRS likes to have their hands in things, it can be used for any qualified what's called 213D expenses. 213D is the list of what the IRS considers to be a qualified medical expense. And what I appreciate about this account too is that I can use it for anybody that I can claim as a tax dependent, regardless of if they're enrolled in my health insurance or not. So if my spouse was enrolled elsewhere, and different insurance and he wasn't enrolled under my insurance, I could still use my health savings account money to pay for his bills and expenses. Again, like I said, it is a true savings account, so the balances roll over from year to the next. It's not like an FSA where you have to use it or lose it. There's no forfeiture piece of it. And when I am using the funds, they're essentially tax benefited. And so when I contribute to a health savings account, it actually lowers my taxable income. So, for example, if I got paid, $1,000 this paycheck gross, and I put $100 into my HSA bank account, I'm only paying taxes on the net $900 of my income. And so it actually lowers my taxable income as well. So I really like that it has all of these different benefits. So when it comes to the savings account, there's also, because it is tax advantaged, there is a maximum amount that you can put into it every single year. The IRS likes to adjust that every single year, usually by $50 or $100. And if you're enrolled on the HSA plan with yourself, plus at least one more other person, you can contribute up to the family maximum, similar to like a retirement account. If you are 55 years or older, you can also make catch-up contributions so that you can, deposit a little bit more than that maximum into the HSA every year. And the HSA funds can also be invested. We have some people that have been putting money in their HSA bank account for years and years, and they have a balance that's suitable enough to be able to invest in the market, get some returns, and then those returns are also tax advantaged, so because they were with tax-free dollars. Like a retirement account, some employers choose to contribute to an employee's HSA bank account. And so you may see in like a benefits guide or something like that where your employer may end up deciding to put some money into the account for you. So then that way you can kind of get a head start when it comes to your medical bills each year. And an HSA account can be administered through either a third party administrator or a TPA or through a financial institution, a bank. And so we'll see that a third party administrator or banks, they'll issue like a debit card associated with this account. So when you go to a doctor's office or a hospital or a dentist's office, you can actually use the debit card right there and then to pay for your medical, dental, vision bills, that sort of thing. So it can be very helpful in that regard as well. So now that we've talked through the HSA bank account, let's re-look at our buckets. And so again, we can see here our traditional plan, more expensive to be enrolled on every single month. So we see that annual total is much higher from a cost perspective. Again, that's money out the door versus having less potential risk. Now, again, in my previous example, I was better off on a high deductible health plan because I would have had less money come out of my paycheck for a risk for a deductible I wasn't going to meet anyways. But now, when you pair it with the HSA bank account, it's starting to look like a lot more sense. It's going to cost me $1,000 out of my paycheck to have that account. I'm going to put another $1,000 a year into my HSA bank account. And so essentially, it looks like I'm enrolled on this traditional plan, but this HSA bank account, that is my money. I own it. It's not an expense that went out the door. It's a savings deposit that is going into a savings account. And now my risk is reduced because I have that nest egg set aside ready for me to tap into if I were to have medical, dental, or vision expenses. So again, back to my previous example where you can see my EOBs, if I had put $1,000 into my HSA bank account, that would have worked really well for me, especially on the year that I had almost $1,000 in medical expenses. So by being enrolled in the high deductible health plan with the HSA bank account, that is the most key piece of the puzzle is that HSA bank account to being able to make it so that this makes the most possible sense. So to really pull us together full circle, we have what makes a qualified high deductible health plan, being able to have those maximums and those minimums, and then not having those first dollar benefits. Of course, first dollar benefits being things like doctor's office appointments, urgent care visits, prescriptions, copays for generic or brand name medication. We also talked extensively about cost versus risk analysis. And so making sure that we're being cognizant and aware of how much does it cost me to have this insurance, what money is going out the door, versus what is my risk by having this insurance with if something happens to me, what could my potential medical expenses be? And then also being able to understand what are the questions and thought processes we should have when it comes to analyzing our medical forecast and understanding which plan is a best fit for us. And then really pulling it together with those HSA bank accounts, those HSA bank accounts being the linchpin for being able to make sure that this all makes the most possible sense. Now, I will say that there has been some recent developments in the law. We saw the One Big Beautiful Bill Act or OB3. And OB3 does actually have some upcoming changes in 2026 when it pertains to making HSA contributions. They've changed some of the language and they've loosened up some of the rules as to how and when you can contribute to an HSA bank account. They've also loosened up some of the rules when it comes to first dollar benefits for really, really high plans, like a bronze plan, for example, that has like a $9,000 deductible. And so I think it's important that while we want to keep all this information in mind, that these things are essentially, tweaked every year by the IRS or by legislators. And so it's important to keep in mind that make sure you're paying attention to your plan designs. If you are attending your employee benefits meeting, make sure that you're asking good questions as far as if anything changed from one year to the next, because we do see that the healthcare is not stagnant in the sense that the plan designs and the plan structures can be changed from one year to the next. And so all that to say, I hope you found this information to be valuable. Really, this is designed for you to be able to prime your brain and be ready going into open enrollment, or if you are assessing which benefit is right for you, that you can take away information from this presentation and understand, okay, this is the thought process I need to have. I want to make sure that I'm not accidentally signing up for something that is more expensive than what it is that I need. And I think really the key element is just making sure that you understand, the thought processes we need to have to make an informed and educated financial decision. Again, my name is Arwen Robinson. Thank you so much for joining me today. I hope you found this information to be valuable. I just want to wish you a very happy week and a happy open enrollment. Thank you so much.